Time for Ask Annex, and in the studio, Fred Coleman, CFP, Wealth Manager. Welcome.
Thank you, Danny.
And we got Matt Morzy, Investment Team Manager, CFP. Welcome to you.
Hey, Danny.
Question number one. I'm 60 years old, want to learn more about the pros and cons of using a reverse mortgage to do a purchase of a new home. Are you able to give me any advice on this?
Yeah, so first off, you do have to be 62 to use a reverse mortgage, and typically you're going to need a significant amount of equity in your existing home. There's really one pro to it. You get increased cash flow because you don't have any mortgage payment. Now, there are a lot of cons as well that go along with not having that payment. First off, reverse mortgages, they're not free. They're going to be origination costs. They're going to usually come with higher interest rates. And then the thing that some people don't account for is that you still have to pay taxes, homeowners insurance, and HOA fees. So if you're used to paying that within the mortgage payment, it can be a little bit of an adjustment. Also, it's a fairly complex financial instrument, so you want to be very careful when you're being offered these reverse mortgages because there are a lot of scams and bad actors that target our senior citizens with these types of offers.
Question number two on Ask Annex. As interest rates rose, I moved more money to our high-yield savings account. What are signs I should look for to put that money back to work in equities?
Yeah, that's a great question, and one that we talk a lot about here, at Annex with our client portfolios and the money that our clients have outside of Annex as well, too. Ultimately, to me, it comes down to what is the purpose or the goal of those funds? Was that money that was sitting in the bank, but you knew you'd want to get invested at some point? Was it money you took out of the market and now you're trying to work it back in? But I'd want to know what the goal of that is. For the sake of this conversation, let's assume you wanted to get that all into equities. What I would do is I would try to stay away from trying to time, which is really kind of where that question's coming from, is how should I know how to time that to get that back in? And I would really be looking to essentially spread that money over a set of period of time, almost like dollar cost averaging. Think about how long you want to take. Is it 6 months? Is it a year? Which should really depend on how much cash that is, especially in comparison to your overall portfolio. Then pick that and just kind of do it evenly. So if you're going to do it over a year, divide it by 12 and do a little bit every month. If you really do want to try to time it, or you want to be a little bit more specific with that, what I would do is have that as your initial goal. But if the market starts pulling back, maybe it comes back 5%, then I would speed it up and I would do the next month's investment right away. The market starts pulling back even further, great. I would speed it up again and set another month's, put it in there. So you're kind of doing both, but ultimately it's what are you trying to achieve? We always talk about timing the market. It's a fool's errand. If you took that money out of equities before, we're at all-time highs as we're recording this right now. So you probably missed out on that. I wouldn't want to wait for a gigantic pullback to try to put it back in because you might not get it.
Participating in the market is, usually the better option. You can look at, November, for example. That was one of the greatest months in the history of the stock market. And if you missed out on that, then you missed out on a lot of potential long-term return.
It's Ask Annex. Got a question? You head to our website, annexwealth.com. Look for the Ask tab. Question number three. Does it matter if an equity moves to a new index? And then he mentions a fairly major company that did move to the S&P 500. Does this somehow legitimize it?
It does, but generally for a short time period. If you're thinking about, is it the stock going to pop because now it's going to go in that index? Generally, right away it will, because you have a whole brand new set of buyers that are going to be going in and need to add it. So, for instance, a company gets added to the S&P 500. You're going to have a bunch of ETFs and mutual funds that track that index that are going to have to go buy it now because it didn't hold it before, but they need to have it in there by the time that is calculated as part of that indice. But what you tend to see is that momentum or the publicity around that tends to fade, and now it's just one out of the 500-odd companies that are there. And people forget. Not everybody knows what all companies are in there. In fact, there's actually 503 in the S&P right now, S&P 500 right now, so it's not exactly 500, but people tend to forget a lot about what companies are in there. So that big pop happens right away. You generally see over time, though, that kind of goes away, and then it's just trading as its own company, and what it's going to do is what it's going to do.
You're about to tell me the Big Ten is not 10 teams? Yeah. Same thing, Fred. Did you ever thought on that?
Yeah.
I think it says more about the actual company than the stock. I mean, to say you're one of the 500 largest companies, that's a sign of the company's maturity. But the companies in the S&P, change all the time as well. So if you go back 20, 30 years, hardly any of those companies that were in there before are still in there now.
Is this like English soccer? Do you get relegated?
You certainly do. All these indices have the rules in terms of what companies are going to be in there. So, for instance, the S&P 500 also has profitability metrics that company needs to maintain. One real famous one going back over the last couple of years was Tesla. And Tesla, although it was one of the largest companies in the world from a market cap standpoint, had to achieve so many quarters in a row of profitability before it could even be considered to be included. So they're one that had a gigantic run up because you could tell what the financial statements look like and where they're going to be. So people were just waiting for that. But yeah, there's certain metrics in some of them. Other indices are just kind of blanket indices and they could just be in there. So there's not as much publicity or the up and down there, but some of them do have certain metrics you want to watch out for.
Matt Morzy, Investment Team Manager, thanks.
Thank you.
Fred Coleman, CFP, Wealth Manager, Annex Wealth Management, thank you.
Thanks, Danny.